Joining us today, we have Ben Laidler from HSBC and Jack Bouroudjian from UCX. Great to have you both here. Jack, let me begin to you. What's your reaction to the IMF cutting its growth outlook for this year?
We're talking about the IMF that is historically so inaccurate. They're worse than our Fed when it comes to their after-the-fact analysis. The reality is this, half of their downtick was because of Germany, and all of Germany really revolves around what's happening with China. So if you really want to know what the IMF is doing, they're really telling us that because of China, there's going to be a slowdown globally. What they're giving us is a blinding glimpse of the obvious.
Ben, your take on this, is it time now that the markets focus on the micro more than the macro, which has driven Q1?
Q1 was all about multiples just rebounding from being over-discounted sort of last year. I do think the gears shift a little bit now. I do think it's more about earnings than it is necessarily about valuations. Markets rallied very strong in the first quarter at the same time that earnings were being cut very aggressively. I think they were overcut. I think the growth outlook we have right now more than justifies actually somewhat higher earnings from here, and I think that's going to be the driver for the second and third quarter.
So how are we set up for Q1 in terms of the S&P 500? What is expected, and where do you think it's been a little overdone?
So consensus says negative 4%, the so-called earnings recession. I think actually markets are looking for somewhat worse than that. I think when all is said and done for full year, we're going to get 8-9% earnings growth. Consensus says 4, so I actually think you're sort of 4 to 5 points lower.
If you're talking about an earnings recession, you're talking about the IMF's global growth forecast. Jack, what do you think? Is this enough to keep investors from diving into the equities markets globally?
Contessa, there have been people on the sidelines basically for the last few months. They've been talking about this inverted yield curve. They've been talking about the slowdown. And what happens? The stock market just continues to go higher and higher. Unfortunately, there are a couple of things that are happening. This inversion that we're seeing in the short end of the yield curve is really a misleading factor. I think it's really a consequence of what is happening in Europe and what is happening in Asia, the negative rates, the search for yield by these portfolio managers. And because of that, people are unbelievers. Remember, you're still talking about a very healthy corporate America here. And that is one of the things that we're probably going to see in this earnings period. As far as the earnings recession goes, look, we might see a downtick, but even the IMF, which is historically so wrong and conservative, is still looking at a rebound in 2020. If they're off by a little bit, that means they're going to see a rebound in 19. And if that's the case, then you're going to see a rebound this year in earnings, which is going to put this market undervalued, not overvalued.
But Ben, so you're optimistic, clearly Jack is as well, but your sector positioning in the US is still a little defensive.
Yeah, we've been dialing back the cyclicality and the risk. First quarter was all about just take as much risk and get as cyclical as you possibly can. I think going forward, maybe we clearly have less upside. We have close to 20% upside for full year, so that makes us maybe 2/3 of the way there. I think you've got to be becoming, a little bit more balanced. The market told you in the fourth quarter how worried about growth it is, and we're having a little bit of wobble today because of that. We're pretty sanguine on growth, but given the length of the cycle, given that we are having a slowdown, the debate is just how much is that slowdown. I think you have to be somewhat respectful to that.
And you're overweight emerging markets right now.
Absolutely. We're running a sort of bit of a barbell. I think the US is just very profitable, very defensive, and I think EM is frankly just mispriced. It is very exposed to this China stabilization, which I think markets just want to be bearish on, and it's been the best performing market in the world, and it's been a huge pain trade, and I think that continues.
Including you like small caps in China. That's a bold thing to be picking.
And the US. I think what they have in common is good growth. In this world where everything's slowing, you've got above trend growth in the US and you've got a reflationary environment in China. I think both of those things are quite good for small cap. And small cap is actually very cheap relative to large cap in both those places.
I was also interested to read that you think that the concern over corporate debt has been somewhat overblown. Why?
The absolute numbers are very high. The structure is very good. Cash to debt is very high. Duration is very long. Fixed versus floating is very high. Corporate profits margins are very high, and we think sustainable. So, the absolute numbers at first blush look pretty alarming. But once you scratch the surface, I think things look a lot better.